Hi, Minuteman 6 here for Minuteman Precious Metals. It's August 9th, 2024 at approximately 7:45 a.m. Eastern Standard Time, and this is our morning market update. Before we get started, please hit that like button. If you're not a subscriber, I'd love to have you. I post new market video updates Monday through Friday, so just ring that bell icon to be notified of new videos. Gold is up $2.30 to $2,427.07 at the time of filming during overnight trading. Silver is down 7 cents to $27.48 this morning. The gold to silver ratio is up to 88.34. Gold showed significant resilience yesterday in the face of economic data and market dynamics that would normally be negative. This suggests that the recent price correction may be nearing its end. According to the U.S. Labor Department, initial jobless claims fell to 233,000 last week, down from 249,000 the prior week and below the 240,000 consensus forecast. This decline in new unemployment filings is generally seen as a positive economic indicator, one that would normally put downward pressure on safe haven assets like gold. The US dollar gained 0.05% on the day, reaching an index level of 103.01. A stronger dollar tends to make gold, which is priced in US dollars, more expensive for foreign buyers, thereby reducing demand. Treasury yields also rose with the 2-year note climbing 9.3 basis points to over 4%, and the 10-year note gaining 5.2 basis points, again to a little over 4%. Higher yields make non-yielding gold less attractive in comparison. Typically, the combination of stronger dollars, higher yields, and improving employment data would be enough to send gold prices lower. The fact that gold was able to rebound strongly in the face of these apparent headwinds suggests that the recent price correction may be drawing to a close. Over the past several weeks, gold has declined from its August highs near $2,500 per ounce, leading some to wonder if the precious metal's remarkable rally since the start of 2023 was running out of steam. However, Thursday's performance indicates that gold may be finding its footing again. The ability to advance in the face of stronger dollars, higher yields, and improving economic data points to underlying strength and a resilience in the gold market. That doesn't mean that our current market is without risk, just that market sentiment has shifted. The first of these risks is the Federal Reserve's policy tilt coming out of their annual summer symposium at Jackson Hole, Wyoming. For gold, the symposium has on average over the last decade been followed by initial strength in gold, which then weakens a few weeks later as bond yields have tended to trend higher. The second risk factor to precious metals markets is U.S. politics. Since President Biden stepped aside for Kamala Harris, gamesmanship is replacing hundreds of years of political procedure, denying people their right to select a political candidate through primary voting. From now until the Democratic National Congress on August 19th, the presumed candidate could be changed again. This ambiguity creates risks in the markets as analysts digest these changes based off perceived economic policies and their assumed effects. The third risk factor for gold prices this month comes from stocks, and the tech sector in particular, which has come under considerable pressure recently. Quarter two earnings for Nvidia, the AI darling and top performer of U.S. equity markets, will be released at the end of August. For the first time in a while, the markets appear nervous. This is despite an expectation to beat their quarter one numbers. Two events have dampened the euphoria: a large sell of stock by their CEO in both June and July, and poorly received guidance from Tesla, Google, Amazon, and Intel. Nvidia's earnings call could be a make it or break it situation for stocks, analysts warned. Gold typically strong negative correlation during equity sell-offs should sustain investor interest, and their capacity to respond will likely remain as long as their positioning isn't stretched like it was earlier this week. So basically, this means that if we see a stock market sell off, we should see higher gold prices as long as there's enough money in the market to shift from those sinking equities into rising gold. If you made it this far, thank you for watching. Be sure to check out Minuteman Precious Metals for market updates and analysis. Thanks and have a great day.